and welcome to Money, Money, Money. I'm Surabhi Upadhyay. It's that month of the year when everyone is scrambling to finalize their tax-saving plans. It's also that time of the year when the country trains its eyes on the finance minister as he gears up to present the union budget at the end of the month. So, two big events from the tax perspective that you have to look out for, and Mr. Anil Chopra, Group CEO and Director Bajaj Capital, joins in to help us navigate through both of them. Mr. Chopra, it's great to have you on the show.
Thank you.
Thank you for joining in. We'll talk about the budget in a bit.
Sure.
Let's talk about the personal tax infrastructure that one has to get in place if they haven't done so already. I mean, we are here towards the end of the year, and there still would be a lot of people who have not been prudent enough to start in April. So what are some of the most important things one has to keep in mind if you're scrambling to set your house in order right now?
But I would start by saying that better late than never. It's already been 10 months into the year and just 2 months are remaining. But still, there are a host of opportunities here through which one could save tax. Now, the biggest section in which one can save tax is section 80C, in which you have plethora of options, right? Starting from NSCs, PPF, equity-linked saving schemes, insurance plans, term plans, ULIPs, traditional plans, even payment of tuition fee also gets qualified under section 80C. So one needs to know as to which of these options are most suitable for him. And the answers would differ from individual to individual. A lot would depend upon whether you are young and in what tax bracket, or you are nearing retirement, or you're already retired. The options would differ from each of these. So let's start with somebody who is young and has just started his career. Now, those who are, say, in the age bracket of 25 to 35, for them, there is a complete life still ahead of them. And they have young children, or maybe they are not even married. So they should be putting more of their 1.5 lakhs, which is allowed under section 80C, into equity-linked saving schemes, so that they can hope to create wealth which would take care of their financial aspirations and various goals which would come up, as their career progresses. But we will not
These schemes, of course, come in with a 3-year lock-in. So that goes without saying that you have to plan in mind keeping these funds aside for 3 years at least.
Yes. Out of all the options that we have under section 80C, ELSS or equity-linked saving schemes which are floated by mutual funds, they come with the shortest lock-in period of 3 years. All others, they come with much longer, lock-in period. For example, public Prudent fund, that's minimum 15-year plan. Then insurance plans are mostly 5 years, 10 years, 15 years, or 20 years. So equity-linked saving schemes comes as a very handy, very popular choice, where the lock-in is there only for 3 years, but that doesn't mean that after 3 years you should be encashing, your investments and consuming it. Rather, you should be keeping it for long term for your future goals, which could include your children's marriage or your retirement, etc.
Let me ask you this. A lot of people who are getting into this mode now and are looking at ELSS obviously have missed the SIP buzz. They've not done it systematically through the year. Would you advise lump sum investments into some of these ELSS products even now, so late into the year?
Well, I would say that this is probably a very good opportunity because the markets have corrected very sharply in recent weeks. So, those who are trying to time the market, although that's not always advisable, but still it comes in as a very handy time when the markets are at lower levels than what they have been in the previous year. So it makes all the more sense to put in lump sum. But to come back to your point again, that one can start with a lump sum and also start an SIP along with it. So, for example, if one chooses any of the leading ELSS, say HDFC Tax Saver or Sundaram Tax Saver or Kotak Tax Saver, they could start with this lump sum amount of 1 lakh or 1,50,000, and simultaneously they can start a systematic investment plan of 5,000 rupees a month, which would take care of their next year's tax saving options in advance.
So hopefully the planning will be a little better, at least with respect to the next year.
Yes.
Now let's talk about an individual who is sort of in the midlife period and therefore already has certain responsibilities, perhaps already has a house and therefore is servicing a housing loan, is also thinking about planning for children, etc. So for this middle-aged category, which are the ATC components that you prefer the most?
Right. So those who are, say, in age bracket of, say, 40 to 60, which means the children are already going to school and they are about to enter college, and he's even thinking more seriously about his own retirement, he should be putting his money into a diversified range of solutions. Like he must definitely have few insurance plans to take care of the protection needs of his family, which would include a term plan to begin with, and a ULIP for his long term plans, etc. Apart from that, he must have a PPF also, because if he is putting all his money into equity, then probably probably he's stretching his risk, a little extra. So I would say that he should invest 50,000 rupees in ELSS, 50,000 rupees in PPF, and 50,000 rupees in a variety of insurance plans, because his retirement is coming nearer and he cannot take as much risk as he could when he was 25 years.
So let me ask you a follow-up question on this. For someone who is in this age bracket of 40 to 60 and therefore needs an element of, protection through insurance and, ULIPs and of course a little bit of equity as well. When we're talking debt exposure, which is the best debt product to go for? Because there is PPF, there's also the 5-year plain vanilla FD with the 5-year lock-in. In terms of debt, which is the better way to go?
Well, it's obviously it's no-brainer. It is PPF, which is much more tax efficient as compared to a 5-year FD. A 5-year FD is suitable only for senior citizens, those who are 63 years, 67 years, 71 years, and they are in 0% tax bracket or 10% tax bracket. Anybody who is paying tax, who is in 20% or 30% tax bracket, for them it doesn't make any sense at all to be locking their money into 5-year bank FDs and paying tax on it. Rather, they should be putting the money in public provident fund accounts where they are earning high tax-free interest. And if they have started the PPF account many years ago, then even the maturity is coming nearer to them.
And this falls under the EEE or the exempt category.
That's
which means
right.
Even when you are withdrawing the corpus, there is no tax liability.
Exactly. You see, the PPF interest as well as the maturity amount is completely tax-free. Unlike bank fixed deposits, where when you invest your amount, you get deduction under Section 80C, but the interest which you earn on it is taxable. So even it is subject to TDS also. So one needs to make one's choices very carefully.
So fair enough, we've got some golden, thumb rules there. When you're younger, you need more equity. As you're growing older, you definitely need protection. You need those insurance policies. And of course, an element of debt where Mr. Chopra seems to prefer the PPF route over and above plain vanilla FDs. But now let me ask you about NPS, which became quite lucrative, attractive. It was a big announcement of the last year budget,
That's right.
which is because you get the additional 50,000 advantage in terms of deductions over and above the 1,50,000 limit.
That's right.
Let me first ask you about your own experiences with how people have come forward. Is it gaining popularity or not? NPS as you've seen it in year one.
Well, on 31st March, we had about 80 lakh NPS subscribers. And as on 31st December, the number grew to 1.15 crores. So which means 35 lakhs more Indians opened their NPS accounts. And we are expecting in the last quarter of January, February and March, even larger number, because as the D date comes nearer, everyone gets woken up and they all want to start their NPS account. So we are expecting huge activity, because this additional deduction is very, very tempting. By investing 50,000 rupees additional, you are saving 15,000 rupees as tax if you are in 30% tax bracket, which essentially means you are only investing 35,000 rupees, and still there is a 50,000 rupees statement which you will be getting, and your corpus will be built upon 50,000 rupees every year. So there are good options available in NPS. The difference between NPS and PPF and other forms of tax saving investments are that here you are getting exposure to equity,
so therefore,
which was hitherto not available.
The hope of long-term wealth creation therefore is there.
Exactly.
But before we wind up this particular chat, I do want to ask you about the caveats as well, because the amount that you will be putting into NPS, I don't think you can withdraw it as easily. It doesn't give you the liquidity of, let's say, a fixed deposit. So what are some of those red flags or the red herrings that one has to keep in mind while you go for this?
Yes, I'll quickly tell you. First of all, NPS account can be opened only by those who are in the age bracket of 18 to 60 years. So we have 40% of our taxpayers are above 60 years. Obviously, they can't make use of it because they already passed that age now. The second thing is that here the withdrawal rules are rather strict, because this is planning for your retirement. As the name itself suggests, national pension system. So this is something which would trigger when you are 60 years of age. So before 60 years of age, if there is any emergency, then you can withdraw it, but there is an initial locking period of 10 years. So you'll have to wait at least 10 years after opening your NPS before you can make your first withdrawal. And even that withdrawal would be limited to only 20% of your corpus amount. And then subsequently, you can again withdraw 2 more times, but with a gap of at least 5 years.
So fair enough, those are the caveats with respect to when you can withdraw. I also want to understand how this product competes with the other traditional, savings products, like let's say NPS or even the post office schemes, and why one should think of NPS over and above some of the other schemes.
Well, for obvious reason that NPS, one can also include equity component into it, which can really give you a kicker of returns. If you compare it with PPF or with other post office time deposit schemes, etc., they are purely 100% debt oriented schemes where the return is assured and it is limited. And whereas in NPS, because up to 50% can be allocated to equity, and equity in next 15, 20, 25 years can give a much higher additional returns over and above the debt component, that your overall corpus can be significant, which can take care of several other needs. So that is the one big difference between NPS and the other schemes that you mentioned. And also there is a choice of 6 fund managers one could choose from. The list includes LIC, UTI, Kotak, ICICI Prudential, etc. So one needs to make a choice. And also there are 2 options. Either you could opt for default option, where how much of your investment should be allocated to equity would be decided by the age. As you grow older, the allocation to equity will keep getting lower and lower, and it would go minimum to 10% just before you turn 60.
Okay.
Or you could decide your own asset allocation. In any case, the allocation to equity cannot exceed 50%.
Okay, so that's the upper cap.
Yes.
Finally, when we're talking tax planning and investment planning for the year, health insurance, a very, very significant component, and also something that saw additional deductions being offered in last year's budget.
That's right.
So how should you look at health insurance?
Well, health insurance premiums have gone up in the recent years for obvious reasons, that the treatment cost has gone up, the hospitalization expenses have gone up. So there was a dire need for improvement or increase in the Section 80D limits, which were done in the last budget. And also there is an additional limit available if the senior citizen parents are also covered in the insurance plan. So if a young person who is say 30-35 years also includes his senior citizen parents, those who are above 60, then one can claim deduction up to 55,000 rupees.
That's quite a significant amount of deduction.
Yes, and with this amount you could go up to a sum assured of 10 lakhs of rupees. And these days 10 lakh rupees is something which is essential, which is required, as compared to the earlier 2 lakh rupees, which one used to feel sufficient, for covering the medical expenses. These days, if somebody is hospitalized for 10 days or 2 weeks, out comes the bill which is in excess of 6 lakhs, 7 lakhs, 10 lakhs. So it's very important to protect oneself against unforeseen expenses.
Absolutely, point totally taken. On that note, we're going to take another quick break. But when we come back, we will be talking about expectations from Union Budget 2016-17. Stay right there.